Okay, let's dive right in. The market every single day is just a wall of noise, right? It's conflicting headlines, emotional reactions, it's chaos. But buried underneath all of that, there is a clear signal. And in this breakdown, I'm going to show you exactly how to find it. You've seen this, you've probably felt this. This quote right here, this is the voice of the retail trader. That feeling of getting completely whipsawed by the market, where what looks like a perfect setup in the morning turns into a total trap by the afternoon. It is an incredibly common and, let's be honest, deeply frustrating experience. But what if? What if we could just step off that emotional roller coaster entirely? What if instead of just reacting to every little price tick, we started analyzing the underlying structure of the market itself? See, that's the jump. That's the shift from gambling to trading. So that's what we're going to do. Right now, we're going to tune out the chatter and just focus on the data. So here's our game plan. First, we're going to identify a really key divergence happening in the market. Then we'll decode where the big institutional money is flowing. After that, we'll pinpoint a specific pricing anomaly, weigh the risks on both sides, and then, finally, we'll put it all together into a repeatable trade plan. All right, so the very first step is to get one thing straight. Not all market participants are playing the same game. Not even close. There's this fundamental split between how retail traders and the big institutions operate, and that split, that creates a divergence we can actually exploit. And this right here, this lays out that divergence perfectly. On one side, you have retail sentiment. It's often emotional, it's reactive, it's driven by the news of the day. It's about searching for that one big life-changing trade. But institutions, they're playing a completely different sport. It's all data-driven, it's structural, it's based on flows. They are not chasing stories, they're hunting for a small, consistent, statistical edge. And that gap between those two approaches, that is where our opportunity lives. So, if the institutions are focused on these massive capital flows, our first job is to figure out where their money is actually going. We need a tool, a way to track this rotation of capital as it moves between different sectors of the economy. And for that, we use something called a relative rotation graph, or an RRG. Now, the easiest way to think about this is like a radar for capital. It literally plots market sectors on a graph and shows us which ones are improving, which are leading, which are weakening, and which are lagging, all compared to a benchmark like the S&P 500. It gives us a crystal clear visual map of where the smart money is headed. And when we look at the RG data for the week of November 10th, a very clear picture emerges. We can see capital rotating hard into these 6 specific sectors: materials, energy, financials, industrials, consumer staples, and healthcare. Now, this isn't a guess, right? This isn't a hunch. This is a direct observation of where the big money is positioning itself. So this list, this becomes our high priority watch list. Okay, so now we know where the institutional money is flowing. That's step 1. Our next step is to figure out how we can capitalize on it. So we zoom in, we get granular on these specific sectors to hunt for a very specific type of pricing inefficiency, what we call a volatility anomaly. This is the multi-million-dollar question, isn't it? Every single day, the options market is making thousands, probably millions, of bets on how much a stock is going to move. Our job is to sift through all of that noise and find the handful of instances where those bets are statistically and significantly overpriced. And this is what the data spits out. This table pinpoints specific stocks where the call options are, for lack of a better word, expensive. That call premium column shows us just how much the market is overpricing the expected move. And that efficiency score, that tells us how often selling this premium has historically been a profitable trade. We're looking for that sweet spot, high premium and high efficiency. This is the statistical dislocation that we can build a trade around. And just so we're all on the same page, call premium is the key metric here. That score of 1.04 on SLV, for example, it means its call options are pricing in a potential move that is way, way out of line with how it's actually moved in the past. It's this extra overpriced premium that option sellers are able to collect. This slide, this explains the entire concept perfectly. On one side, you have the implied move. That's the market's expectation. It's what's priced into the option, often fueled by fear or greed. And on the other side, you have the historic move. That's the reality of how the stock has actually behaved. The entire strategy is built on profiting from the gap between market fear and market reality. We are selling that overpriced expectation. But of course, there's no such thing as a risk-free strategy. A true data-driven approach means we have to be brutally objective, not just about the opportunity, but also about the potential downsides. So let's take a hard look at both sides of this trade. So the bull case is pretty straightforward. We're playing a high probability game. We are systematically selling premium that is statistically likely to be worth less in the future. Now the risk, the bear case, is that some black swan event hits, a sudden violent spike in volatility that causes a move far bigger than expected, and that can overwhelm the premium we collected. And we absolutely have to respect that risk. Look, this entire analysis isn't about giving you a single hot tip. It's about building a systematic, repeatable process that you can use to find an edge in the market, week after week. It's about building a framework for making better decisions. And here it is, the whole thing broken down into 4 clear steps. Step 1, you have to filter the noise. Acknowledge the chatter, but commit to the data. Step 2, scan for that institutional rotation. Follow the money. Step 3, isolate the anomaly. Find those specific tickers where risk is being mispriced. And finally, step 4, execute and manage. You sell that overpriced premium, but you do it with a rock-solid risk management plan. This is how you turn raw data into action. At the end of the day, making this kind of strategy work comes down to just 2 things: the discipline to stick to your data-driven process, even when it feels uncomfortable, and having the capital, the liquidity, to navigate any unexpected moves. So, as always, stay disciplined, stay liquid. And just a reminder, of course, this analysis is for educational purposes only. It is based on a snapshot of data at a specific point in time, and this data changes very, very quickly. So please always conduct your own due diligence before making any trade decisions. We are tracking these institutional flows and volatility anomalies in real time. While you analyze the next move, you should check out the tools in the description. You can sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVDA on Moomoo. All the links are down below. And hey, like and subscribe for more deep dive analysis.